It's my pleasure to introduce Professor Alfred Wagenhofer. And Alfred is a well-known scholar in our accounting analytical field, and he has influential works on earnings management, impairment rules, accounting standards, and so on. So today he will talk about principle-based versus rule-based accounting standard. And for the seminar, if you have a question, feel free to jump in. You can also use raise hand function of Zoom or the chat box. And also for the very last 5 minutes, please just give the very last 5 minutes to Alfred so that he can summarize the presentation. Okay, Alfred, the floor is yours.
Thank you very much, Lynn. First of all, I'd like to thank the organizers of the Accounting Design Project to invite me to give this talk. It's a great opportunity to share and discuss ideas across the globe in these times, so it's not that easy, and I really appreciate any comments you may have on this topic. This is joint work with Stefan Schandl from the University of Melbourne, Australia. Stefan, to give you sort of a background, was a former PhD student at the University of Graz, and I'm extremely excited working with him, and we have done a couple of papers so far, and this is a very recent paper, and it kind of like touches on a very fundamental debate in accounting on principles versus rules, and what benefits and costs of those may be. So the motivation is simply that it's a fundamental question, and it may goes back to really the first standards in particular, but then obviously Enron and other events happened, and then we got SOX, you got SOX actually somehow. We did, and they required investigation into exactly the question, is principle-based better than rules-based? So this was the report on adopting principles-based accounting. So the SEC did this exercise in, I think it's like 60 pages, so really showing discussing all the benefits and costs of these things. But it didn't stop that at that point in time. So we got a lot of applications to our implementation of IFRS across the world, very different base systems. And then later on, when IFRS came, and IFRS is arguably a pretty much principles-based standard, although one can talk about this sort of nuances later. But in many places, it was like a very, very difficult to align it with all the accounting environment. And just a very recent example I came across is the Korean setting, where the Korean Accounting Association and the Korea Accounting Institute published 100 pages essentially on principles-based accounting and what they should do. And just to give you sort of a glimpse of what's the argument there, it's kind of well known for many other places in the world. They have local rules, and they are very, very much rules-based, what they have. And then when introducing IFRS like 10 years ago or so for the public companies, they came up with a lot of difficulties and judgment issues, and for auditors, for the firms, but also for regulators. And I just give you a glimpse on that. So unprecedented difficulties this is what regulators had so far with IFRS. Under the prior rules-based accounting system, the regulators simply determined whether the companies complied or not. In the principles-based system, the regulatory bodies are required to determine whether the method chosen faithfully represents the economic substance of a certain transaction. And this created a lot of issues there, and this was the basis for this report to come up with ways to move on and get a little bit sort of better with implementing and using IFRS, and particularly for enforcement they recommended like expand the structure, using more experts, punish based on process and not only on the results. So if the process seems okay, but sort of they made an error in a way, so on sort of unintended kind of thing, or preventive supervision and things like that. This is all in this report, and this closely ties actually to what we're doing in this paper. So here, just a few glimpses of principles-based and rule-based. So it's not even clear what the names, whether there's the best definitions or names for those things. When principles-based had been called also objectives-based or concepts-based approaches. And the idea is, and I think most people would agree on the base idea, maybe not on the details of each, but it's like a general principle that firms interpret and apply to the specific circumstances. It requires professional judgment, and it uses more information of the firm to come up with the accounting for particular transactions. Whereas the rules-based approach mandates a uniform standard for a set of heterogeneous transactions and events. And this is exactly what we're going to look at. So in practice, apparently, evolution over time happens. So people or standard setters might want to start with a principle and think it's going to work. And then firms come and say, oh, it doesn't work. We need application rules, exceptions, additions to rules, much more guidance. This was the US developed over a lot of time. IFRS not that much, but it's going in sort of a little bit of a similar direction. So that leads to issues like exceptions, inconsistency, and a lot of complexity on all sides for firms, but also for auditors and regulators.
There's a question from Yang.
Okay.
Alfred, I don't want to interrupt. If you want to finish this slide, no, you're welcome to.
Sorry, I mean, it's fine with that.
Yeah. So I have a question about just kind of like follow up on the definition of principle versus rule-based standards. So when I read the introduction, it sounds like I'm a little confused by how you define it, because I understand that in practice, people do not have a very clear definition what I mean as a principle-based, rule-based. So when I read the introduction, I kind of like come up with 3 different definitions somehow in the writing, and I just need you to kind of like help me clarify it. So version 1, when I read it from the second paragraph, is that it's still a bright line standard, but there's a single bright line standard versus a multiple bright line standard. That's kind of like the first version of the definition I read from the second paragraph. There's kind of like either we have 50% probable threshold for all the firms versus 30% for airline companies, 70% for manufacturers, etc. So that is the first definition. The second definition I got is kind of like from the 4th paragraph, when you use kind of like a probable example, it sounds like it's a degree of the judgment, how much freedom that the standard gives managers to exercise their own judgment. The rule base is defined as there's no freedom. That's R&D, internal R&D, just expense. There's nothing we want you to make any own judgments. But principle based in that way is defined as you have some room. So that, and these 2 definitions, I think sometimes can be inconsistent with against each other, right? Sometimes you may have. So I just want some clarification on what exactly is your own definition. Even in practice, people never really clearly define it. Yeah.
Right. I mean, I wanted to tell that in the next slide, and the reason being that I want to make sort of some advertising for analytical methods in doing accounting theory, because we have to define it exactly to be able to model it. Right? Yeah. So what we did in the beginning is like having these different kinds of ways people tend to use those things, but it's little clarity, and as you said, I mean, and you're right, I agree that it's not the same thing, the 2 things that you mentioned, but there are many more of those, and particularly there's maybe some areas of transactions where it's again different from one or the other. So and this is probably one of the problems of the discussions that we have seen so far. vagueness, flexibility, kind of these things come in, and they also might be sort of give a different flavor to the discussion. So the reason for doing it analytically for us, I mean, it's the way I like to do things, but essentially I think the benefit is that we clarify exactly what we do, and I will show that in a minute. But we do threshold standards, and with threshold standards, it's close to the first sort of definition you used, because that's easier to handle analytically. But that's kind of bringing clarity into the arguments, and then trying to develop the main economic effects from these definitions that I'll be showing to you in a minute. Okay.
Thank you.
Thanks. Right. So in practice, I mean, many people talk about degrees of principles versus rules. So it's a mix very often, and particularly in practice, probably most of the stuff is a mix. We got this vagueness and flexibility and things like that. So and this is exactly what I wanted to say here anyway. So by doing an economic modeling, we have to define what we mean, and we clearly define it based on an economy that we have, and then we say, oh, this is like what differs between those two approaches. And I talk about this a little bit more later on, but also when I show that the formal structure, I have one or two examples, and the expensing of R&D is a clear example of a rule, right? Where there's no information needed to apply the rule, but it also no information additional about what's the transaction itself, and you don't get as much information. So this is the trade-off that we actually are after. So I think the innovation part here in our modeling is that we really look at heterogeneous firms and try to come up with what would be a better approach to standard setting, because it's not I mean, we use a single firm, but it's of different types, and so one can imagine there are many types out there, and they behave differently, but investors would understand the effect. So while we look at a single firm, it could have different projects, and the standard setter needs to figure out what will be the best standard to provide the best kind of information for investors as the users of financial reports in this regard. So we try to look at economic effects of different standard setting approaches, and also look at the optimum standard within an approach. So we look at principles and rules and say, oh, okay, what would be the best way to a threshold in our case in given one approach, and then we take a step back and say what would be the better approach to look at those things, and we really focus on the enforceability kind of issue. And this is like what I found kind of interesting of the Korean report, because the enforcement was one of the major parts in that report as well. So the idea would be principles-based can provide more relevant information if enforcement works. So if we have enforcement frictions, then while it aims to bring more relevant information, it can't often do this. And then rules-based might be the better way to deal with things. So losing some relevancy versus increasing enforceability. So this is what we mean with relevance enforceability trade-off. And we look at particularly two kind of frictions, that enforcement is costly, which it is, I think, and it's differently costly for rules versus principles, which is also kind of a key difference. So it's easier to enforce rules-based standards. So this is what we capture with that, and it's not always perfect. So there might be frictions in there. And that depends on the information that the enforcer can get when investigating a firm and trying to figure out whether this was compliant or non-compliant with the set. And so I think this is like analytical research is kind of a normative statement, and this features very nicely with the accounting design project as far as end, because it's also has this normative flavor in it that one can talk about what would be a better standard given some objectives that we might have. And we really look at investors as users and making decisions, and they make investment decisions. So it's real effects stories when we can talk about sort of information efficiency.
Alfred, there's a question from Joshua. Joshua?
Joshua, you're muted. Joshua, you're muted.
We cannot hear you. Joshua, how about you type your question in the chat box, because we cannot hear you. There's probably some difficulty in the audio on your side.
Okay. Should I go on meanwhile? And
there actually also a question from Sulipta Basu, that how different is this from modeling debt covenants?
Well, I haven't thought about that, because it's we don't do contracting stories here. So this is like a contract where you assign decision rights from one party to the other, and that would depend on accounting information, for example. Here, it's general regulation of information that people receive. So it's more the usage of information for decision making by investors, rather than sort of the monitoring kind of effect by debt holders. So I'm not sure whether this helps you sort of. That is a good answer to your question, though. So. But it's kind of different thing, because the debt covenants would also depend on accounting information, but you have it's governed by contract, by an individual contract between the two parties. That would be different.
This is a test. But I mean, the contracts themselves sort of specify sort of similar accounting rules. There's sort of debt contract sort of templates or books on sort of what you should sort of exclude from the GAAP numbers and so on. So, I mean, it has a similar flavor, and obviously debt holders are making investments based on the rules of the game. So, so I think it's just another way of thinking about this, but so it just seems interesting that there are these parallels, that's all.
Okay, no, but as I say, I mean, my response would be that if I do contracts, then I can pinpoint the exact relationship and the economy I'm looking at. When I'm a regulator, a standard setter in accounting, I have to look for a larger economy, and this can't be sort of adjusted by single contracts. But as you say, I mean, so the EBITDA and non-GAAP measures that you can contract on, but also what firms disclose, and in addition to mandatory reporting, might provide information. But what we look at here is really sort of, this is a given setup with a threshold standard that we look at in a minute, and we really figure out what would be sort of the best for a regulator to govern the economy in terms of investment efficiency in general.
I'm sorry, can you hear me now?
Yes.
Oh, okay.
Okay, Joshua. Okay,
Thank you. I'm sorry. Yes. Okay. So my question, Alfred, is you appear to be assuming differential cost of enforcement, right? Mm-hmm. Now, in reality, in the US, if you go to a court, you're still liable if you provide misleading information, regardless of whether you follow GAAP or the rules. In the case of Enron, that was quite clear. So basically, the court will have to judge as to whether you have misleading information, that investors were misled, even if you followed GAAP faithfully. So that may suggest that the assumption of differential enforcement cost may not be realistic, at least in the US setting.
Okay. I think what we mean here for enforcement cost is this like direct investigation cost. This is how we model it. So we don't look at litigation and other sort of effects of enforcing regulation. I mean, there will be the auditor as well, internal controls, and many others, and litigation is one other one. So essentially, our differential cost of enforcement is the cost of litigation, and the way we do it is we make it even easier for analysis by assuming there's a fixed budget for like the SEC when doing enforcement investigations. And the problem and the reason why we get to differential cost is that once you have principles-based standards, you need more information, you need to dig deeper into the firm, trying to figure out what actually happened and what are these other characteristics of transactions relative to rules-based, where it's much simpler and you need less information to enforce and figure out whether the firm complied with the standard or not. So this is how it creates our differential cost. So we don't talk about litigation and damage and all these payments and other stuff.
Well, yeah, I mean, even if the SEC investigates, it's still as to whether information was misleading, irrespective of whether you follow GAAP. Obviously, if you did not follow GAAP, the penalty may be higher. But in any case, the SEC investigation, any investigation would have to see if you had misleading information or not. But anyway, let's go forward. Let's accept the premise at this point.
Okay, there are more raised hand. First, John.
So appreciate that in one of your slides that you recognize the dynamic development of the accounting standards. Maybe start as a principle-based, but then because the complex interaction between the enforcer, between the auditor and the preparer, it become more rule-based, right? You cite Shepperton 3. And in our own example, right, 10-year standard, all the schools that this have national reputation. There's no set numbers of our articles, but in reality, this all of us have this journal list, have this number of articles, at the rule of thumb. So my question is that what do you think about this? The initial standard versus, in the end, all the principle going to evolve into this rule-based standards?
Well, as far as we see it and have observed, and as you noted, I mean, this is what seems to happen. There's a lot of lobbying around, but also learning in the first place. So, I mean, one could do the simple principle, present all the relevant information faithfully, right? And nobody would know what to do with that, and so there is uncertainty about how to apply those things. So firms would pressure the standard setter to come up with something with guidance and things like that. So as I say, I mean, probably in reality, it's like what we get is kind of a mix of things. So for particular areas, it's a little bit easier to have sort of a more principles-oriented way of dealing with things. In some other areas like R&D, for example, it's more the rule kind of structure because it's much harder to get additional information or to enforce the thing, right? And this is what we really are after. How would you be able to enforce that? And is it too costly? And that would determine apparently the way to deal with those things.
There's also a question from Paul. Paul, it's your turn.
Did you say me, Paul? Oh, I'm sorry. Yeah. So just
Yes.
Alfred, I just want to understand something. You mentioned the R&D example. And when you talk about enforceability, I assume you mean the problem is overcapitalization that really is undeserved, okay? That the firm wants to increase its assets and equity. But remember, the problem on the expensing side is earnings management, cutting back valuable investments, okay? So are you ignoring that problem and just focusing on the overcapitalization problem?
Well, our R&D expensing is just an example. So we don't have this in our setup. I mean, one could interpret the project that the firm is going to do, and I introduce it in a minute, could be an R&D project. And then the question will be, is it possible to recognize it in order to give more information to investors about the probability that it's good? But what you're touching on is also the issue of accruals versus real earnings management.
Yes.
So you can shape sort of the expenditure themselves and then say, oh, let's invest more or less. Or how do I report about a given number or amount of money invested for that? So we only look at accrual management. We don't do the real earnings management.
Okay.
But there are papers that try to distinguish between those in a sense, because both are probably or could be at work. So once you have real effects and you do a signal, then you overemphasize the signal, kind of these things. So what we do here is really sort of a very simple threshold equilibrium, like saying, I mean, the way we do it is so if the project has a positive NPV, expected positive NPV, then you should recognize it and should give the signal. Otherwise, you give the low signal, right? And so this is the formalization. I mean, this is like a very special case in a sense, but we believe it captures sort of the notion of what the trade-offs are like in doing these things.
That's fine. Thank you.
Okay, so to give you sort of a glimpse of the results before jumping right into the model is we have these heterogeneous projects, and there's a simple report, good or bad, kind of high or low. And we have investors who acquire a firm because the firm can't invest in a project, it hasn't that much money, so it sells the firm to investors who would engage into this project. And this setup creates an incentive for disclosure, but also for earnings management, but this is accrual earnings management. And it also generates a demand for reporting regulation, because in models like this, you would not want to have sort of a setup where it's not clear what a regulator would do and what's the benefit of a regulator. You know, so it must have a real effect in order that the regulator jumps in and says, oh, okay, we push for financial reporting regulation. And as I mentioned before, so the trade-off is more relevancy versus higher enforcement frictions and enforcement costs. So the main results later on are essentially that the enforcement regime, so it's penalties, investigation intensity, which is the cost, our cost of enforcement proxy, determines the approach.
By the way, there is a question from Emilio. So Emilio, you want to just speak out instead, because you have a long message in the chat box.
Okay.
Yes, sure. Hi, Alfred. I think that goes back to one of the questions that Joshua was raising before. I mean, in the end, if you are the regulator here, and you're only worried about the cost of enforceability, I mean, you may discard that in a principle-based environment, other contracting parties may actually help or shape firms' behaviors, right? And exert an ex-ante monitoring. Whereas in a rule-based setting, most likely, I mean, we know we have evidence that managers and firms try just to comply by the rules, and that trade-offs the ability of accounting information in providing a signal. So I don't know to what extent, I mean, my question is, to what extent can we abstract away the very nature of the underlying regulation from how other parties will react and actually contribute to firms revealing truthfully? Thanks.
Well, this is actually sort of an important issue because we just have this very simple regulatory system and the requirement. We don't touch any voluntary disclosure issues right across, but given the setting that we have, that means that the firm has a clear incentive, the entrepreneur as yet has a clear incentive to shape what to report. So we can so any other disclosure, voluntary stuff is probably not sort of credible in a sense. So the idea about sort of regulation and public reporting is it shapes credibility. So it's enforced. So this is a key issue. Otherwise, you wouldn't believe it. So and the other one which I mentioned as an argument for an earlier question is like obviously there are contracts and there are many contracts between parties, and they can do whatever they want, right? And so regulation, financial accounting regulation, usually does not do as much put as much focus on contracting, providing contracting information. This is the stewardship kind of thing that has been, ISB particularly has been struggling with for a long time. But they say you can write your own contracts and use your accounting whatever you like. I mean, it might be costly if you deviate too much from that, but you also need to enforce it in a sense by the auditor at least, or by other parties. So, but here we're in this kind of capital market setting. So there are investors. They just get this information. They don't have a pre-contract with the firm, and they say, "Oh, okay, this looks like a very neat thing. So we provide capital and buy this stuff at the price that is determined in equilibrium." Okay, so this is like what we believe is a lot of financial reporting aims at. Looking at investors, users that are not tied by contracts yet. Okay.
Yang, there's a question from Yang.
Okay.
Alfred, one thing I kind of like curious about the model is that right now the focus is on the cost of enforcement, direct cost of enforcement by the regulator. So the results kind of like, not surprisingly, is also that penalties and investigation determines kind of like what approach the regulator should take in terms of standard setting. So one thing I have in mind is that kind of like, can you vary the heterogeneity across projects? So what I have in mind is think about an economy more have like kind of more standardized projects, more like a manufacturing, post-World War II manufacturing US economy versus today is that the heterogeneity actually is very sparse. We are chasing after innovative new ideas that have not been discovered before. And then somehow projects across firms are very different. And that potentially will be another trade-off in addition to investor having relevant information, enforcement cost, but at the same time, regulator also in some economy were curious about how innovative, whether they kill the innovation by imposing standardized one single threshold versus kind of like heterogeneous threshold. I just think that potentially, if it's not difficult to kind of like tweak into the model, that would kind of bring up more richness to the model in terms of implications. And you can talk about what kind of economy will have what kind of the standardized accounting rules or regulations be chosen. Yep.
Yeah. It's an important issue about talking about innovation in different projects. So particular, I mean, this is like the typical argument for principles-based. So if you don't know what you regulate at the moment, so maybe half a year might be very different. And so you want to have standards that also applies usefully into these things. So what we do here is, I mean, we do have the two projects that go through most of the paper, but at the end, it works with a continuum of different projects. So heterogeneity would still be able, we can show, and with our last one of this cost enforcement kind of stuff in here, it goes in, at least in the direction. I mean, we don't model sort of unknown projects that would come voluntarily or by chance, because that's very hard to do analytically, because you always need to have some idea of what about the set where the projects would come from. So as long if you're totally surprised, nobody ever thought about that, then it's like you know, very hard to say it and to optimize and to do something around this. But we don't sort of push those heterogeneity issues as being the most important part. Because any rules-based standard would have to look at all the projects and look at a particular average project essentially, and then you have the problems on the sides where the projects become more or less heterogeneous, right? Whereas with principles, you're closer to the individual projects, right? So this is like the trade-off, and if they're farther apart, I mean, the cost would differ, but the main results would still apply.
you.
Okay.
Thank you.
So let me quickly do the literature. I mean, I'm running out of time. I think it's half an hour already. So there's this standard setting conceptual literature, and I just mentioned those. I saw Katrin Schipper being in here, and I have a paper with George Benston in this regard. This was all SOX related, but also a more recent one about you can't write standards that don't allow for financial engineering by Barandai et al. There's quite a bit of analytical disclosure literature, and this is the closest to what we do is this classification standards area. So it's particularly around Dai's paper in 2002. We started with that. There's a more recent paper by Laux and Stocken. There are other papers that look at analytically about flexibility of standards in different settings in more broader capital market settings. We also see that there's some early law and economics literature, and for example, that maximal penalties might not be optimal. This is something we get also as a result. So you would like to reduce penalties in some cases. So if the enforcement errors get too big, because it reduces welfare, so that will be closely related to that. Okay, so quickly running through fundamentals that you see what is the setup we look at really is. We have a risk neutral entrepreneur, and this she has a risky project but is cash constrained, and so the only way to make money out of that is to sell it to risk neutral investors who invest in the project when they acquire the firm and they have rational expectations. We look at 2 projects, but later on we look at the continuum. So it's possible to do this a continuum, but with 2 it's kind of sufficient for what we want to show. And to make it really sort of important to have information is we assume that they are ex ante have then the same MPV, which we normalize with 0 to begin with, but they have different risk and return profiles. So the A project, this is this one, has sort of a continuous probability of being successful. The data is a success for going from 0 to 1, whereas the other project is the one that has a low probability of being bad, really bad, but has a high probability of being good. But in order to get to the same MPV, the outcome is lower. So essentially what's happening, if you multiply this by the expected return or payment, then we get these kind of thresholds where each investor, once you know all the information, you would invest. If it's an A project, you would invest starting from here. If it's a B project, you would invest starting from here. So all these things are the good ones, and you don't want to invest here. Okay, so that's the kind of idea, and so this is how it works. So we start with the regulator, who chooses the threshold on the rules-based and principles-based approaches, which is a point in between for the probability for the data. The entrepreneur learns the type of the project plus the probability of success, and reports a high report if it's above a threshold, and a low report if it's below a threshold. Investors make a decision, so there's no contract here, so they just have rational expectations and decide on, based on Bayesian updating, decide on what they would pay, whether they would invest, and what would be the price for the...
question from John.
Okay.
So in the United States or in the Europe as well, the standard setter, ISB or FASB, is not the enforcer. So how does that going to change the type of standards going to be issued?
That's right.
So in your paper, does that imply that because FASB never think about the enforcement cost, maybe they issued too much of the principle-based standards?
Mm-hmm. Okay, I agree that sort of in practice these are 2 different ones. So in other countries like Europe, it's the same basically. So because we have accounting directive from the European Union, and so this is basically kind of a law in the country, and so it's and the enforcer is but they might be private, so you might even mandate somebody else and do something with that. So we just simply assume the best of the world, in a sense that the regulator knows how to enforce things and then does the best. In the US, I mean, the SEC still has the power to overrule the FASB standards, which it does, I think, to some extent in particular areas, or provides additional guidance and things like that. So but I agree. I mean, if you do them as model them as different players with different objectives, then we would get something different. And the same goes for litigation, right? If you add those things and then see what's going on. Okay, but we assume that the enforcer is the same as the regulator who sets the standards also enforces the standard. Okay, so that would be the last part. So it's again the same regulator here, and the intensity is like the cost argument here, and then the regulator imposes a penalty.
I have a question, Alfred.
Okay.
So you go back to the timeline. So the investor decides whether to invest first. So I feel that is that true that if you switch the last two time points, it should still work, right? So if regulator investigates first, and if the investigation find the company actually has a fraud or a misreport, the investor then decides whether to invest or not. I feel that still should work, right? I'm just curious.
Okay, I mean, this is like with a regulation and enforcement, it usually comes later. So you have information and people react on the information, and enforcement comes at some later point.
Sure, that is still a very reasonable timeline. I'm just curious about technical.
Well, it would change to some extent. I mean, I don't think it would change the basic structure, but if you can wait to see what enforcement brings, then you get this kind of probability intensity, which the enforcer figures out what was really the case. Then you can make a contingent decision on those things. But if the enforcer doesn't say anything, so you don't know whether there was an investigation or there was an investigation and there were no error, then you still hit in the same setup as we have, because the investors just don't exactly know what the firm did. Okay, so but it would dampen the effects to some extent, but I think it would keep sort of the main thrust of the paper.
Thanks. There's a comment from Christian in the chat box. Christian, you want to say it, or you want to leave it in the chat box?
Hi, I don't have my thing on here. I just wanted to say that it is reasonable to assume that when board members are setting standards and when the staff is making recommendations, that we do consider enforceability and auditability, because, you know, if we were to set a standard that could not be audited and could not be enforced, that would be a bit of a problem.
Okay, thank you. Yeah, I agree. Okay, so let me quickly go through the idea. So just to get this sense of what the earnings management is that we do, is that the entrepreneur actually always wants to report high, because then he will be able to sell. And the problem there is if the investors understand that setup, then they pay a price of zero. So there's no engagement, because they don't believe you, right? Because given the net present value being zero, normalized to that. So essentially, if you look at the types here, from 0 to 1 and say this is the standard, then here we have truthful reporting, because the firm is happy to report the right signal or right report. Here it would like to report RH, but there's a penalty, and the penalty is kind of increasing here in this regard. So there's a trade-off. So the little penalty with little probability is like, okay, but if it becomes higher, then you stop doing this. So you get this internal sort of threshold here. And this is like what the shadow standard in the paper from Dai, so you always do a little bit earnings management, depending on the penalty. So this is the structure we work with. And then we have this benevolent regulator and looks at social welfare, which is investment efficiency here. So because good projects should get paid, should get invested. Okay, and we look at the standard setter, and here's what we have is rule-based versus principles-based.
The number previous year.
So rules-based, you have a common threshold. In principles-based, you have different thresholds. And the problem here is not so much the different thresholds, but the enforcement, because once you have different thresholds, the enforcer must figure out the type, which you don't need for the rules-based. Okay, so this makes it more costly to do this investigation. And this creates the cost. So in terms of modeling, we talked a little bit before on principles versus rules-based examples. So revenue is recognized if it's earned. Okay. Here, what we have, it will be the NPV. Positive NPV will be the ideal principle, right? And that would depend on the kind of, given the data, it would depend on the project type. With rules-based, it could be, even if it's like probable and say a half for any project, that would be a way to do this. But if you add this R&D expenditures we talked about earlier, where you have the data, sort of the threshold at 1, so none of that should be recognized, then you already have kind of like 2 rules, which would be in a 2 setup setting that we have, would be kind of a principle. So as I said, in a binary type setting, the principle can express these 2 rules, but we don't this, and as I said, we do have this continuum of types, and there it wouldn't work with with many rules in this regard. So just briefly, the no enforcement case is pretty obvious. So the entrepreneur would always report high, but then using rational expectations, investors would never invest. So this is not a solution to the game. So no voluntary disclosure kind of thing without enforcement. So if the entrepreneur fully complies with accounting regulation, then the regulator could say, oh, I just set the optimum so thresholds, and this will be these, which is exactly where the NPV, the probability where the NPV of a particular project gets positive, right? So that would be the ideal setup, and this is like the first best solution and our benchmark. For the rational expectations, we do market pricing, and so they do whatever they do. Reporting choice, the entrepreneur assumes or conjectures the price that would come up later on, and this is the expected penalty, and that should be greater 0, right? And then you make the high or low decision. So this is how it works here, and the regulator conjectures both and tries to set the ideal standard. So let me jump into this. So I don't want to go into equations, just to show this is not absolutely totally simple. But what the interesting thing is, you get this kind of setup where there's aggressive classification, as I showed in the picture before. So the entrepreneur always pushes a little bit below the standard, because the probability of being caught is low, and the penalty is low, and so it might be worthwhile. And this is, but the market anticipates all of that, right? And then the regulator chooses the kind of threshold. So this is how it works. So here's the penalty size. So if there's no penalty, then we end up with what the firm would do anyway, with a penalty, always say high. And then it's absolutely useless. What you get is information. So if you increase the penalty, then given the standard, you would increase the report. So this is like here, this difference from the benchmark and the threshold that the entrepreneur chooses. This is like where you get this high report. Okay, so we come closer, the higher is the penalty. And once you reach this line, which is like the average optimum for both types, then if penalty increases, you lower the benchmark in order not to overinduce things and provide less information actually again. So this is like a substitutive relationship here. And we get never first best. We get overinvestment in one project and underinvestment in the other project because they only can regulate the average, right? So this is how this one works. If you have principles-based standards, then we get two different benchmarks. So the standard setter sets basically two different levels. And the interesting thing here is we still get the same biasing in a sense, because the penalty system works similarly for both, right? And so we get this for both, but the regulator can control sort of the level, okay? And the whole thing looks like this then. So for the A project type, I mean, at the beginning it looks like what you had before, but once you reach this, then you can distinguish, and then you can lower the level of the benchmark to keep the A-type entrepreneur here at the optimum, whereas the regulator keeps the benchmark very high to still increase the sort of the precision of the B-type disclosure until here we have again the first best. So we can achieve first best for particular penalty size, but it comes at a higher cost. So this is like the trade-off here, and in between the regulator pushes with different kinds of standards for the two types that will go on for both, right? So here principles-based is not implementable, because you have only essentially one standard, right? For both. So this is a rule-based and it's less costly anyway, so you keep it rule-based. Here we get first best for A, but not for B. And here we get first best, but still at a higher cost. So this is how this base setting works. And then we compare the standard setting approaches. And we have only the two lines. If you look at the social welfare investment efficiency here, and what we see here is at a particular point in time for high penalty sizes, the principles-based is always better than the rules-based, even though it's more costly. And the reason being that sort of if there's a high penalty, then even a low probability of getting caught still has a lot of deterrence effects. So it still gets better at the end. But here, so far, there is no way. So here is the cost problem, right? For the standard setter, so that for low penalties we always have rules based, and for high ones we have always principles based. And there are two ways to structure different approaches. So PP can be optimal whenever it's enforceable, which is the case here. So whenever it starts being enforceable, it's better. It's improving, and this works if the incremental cost of principles-based enforcement is low, right? So it's not much more expensive to do enforcement for principles-based. Then whenever it gets possible, then you do it. On the other hand, if there is there might be cases that principles-based is already enforceable, it would start from here. But you still wait before principles-based is beneficial, and this will be if the cost of enforcement of principles-based is relatively high.
There's
John.
a question from John.
So what do you think about, instead of assume that the regulator objective function is to maximize the social welfare, instead they want to minimize the chance of being blamed? How that going to change your results?
Mm-hmm. I'm not sure I can answer that. I mean, I have a paper with Stefan actually in JE from last year, where we have an enforcement agency, a public enforcer, who really exactly cares about that, not being caught, that it was not, didn't do their jobs. So one can play around with those things. I don't know how exactly that would jump in here, but because we would need to have, I mean, the enforcer here has not much to do essentially in terms of strategic decisions, right? So he has a chosen probability, chooses among the firms and then picks 5% or 10% of the firms and looks at there and makes no errors in compliance, in looking at compliance here in this setting. In a minute, yeah, a few minutes. So I'll look at sort of imprecise enforcement, but it's still the enforcer here is a machine, right? So
historically, I do observe that regulators are blamed for issue the rule-based standards, right? The least standard, the 3% special purpose entity, or the R&D, right? The rule-based. But I'm not aware of any cases that standard setters are blamed for issue, too vague principle-based standards. So that seems like to, the regulator going to face different incentive between this choice of the two type of standards.
Mm-hmm. No, I agree. I agree with that. I mean, that would be kind of interesting to look at specifically. But as I say, I mean, if you look in my earlier paper, we do this kind of thing, and there come weird things are the results. So it's not that obvious what would be an optimal result. So I suppose it could be here as well. So right. Thank you.
Okay, so since we only have several minutes left, please leave the last several minutes to Alfred to wrap up. And if you have further questions, you can leave in the chat box for him to check later or email him. Thank you.
All right, thanks, Lynn. So I do just one kind of interesting extension, and I was saying a perfect ex post verification is like sort of the gold standard, but it's probably not possible. So we particularly look at imprecision of imprecise enforcement. So the enforcer makes errors in figuring out what type we have. Okay. So and this leads to kind of a fancy setting in my view, because the two types are differently affected by enforcement errors. So that project type A, the type A type has like if there's a possibility that is considered a B type and has to pay penalty, right? So it could be even if it would be in complying, right? There is a risk of penalty. So the other standard becomes relevant for the firm, for the type A, and here penalty would be, even here it would be too high because it increases with the deviation from the standard, right? So here we have sort of a too high penalty relative to the actual type, whereas of the other type, the B type, it's always too low a penalty relative to what it had if it was only fully understood it was a B type, right? Because it always might be an A type, and then and here there would be no penalty, for example, right? So doing this creates a substitution effect among the two standards. So if you increase one, you have to lower the other in order to not to be too strict with those things, and it really gets messy, and it's not easy to show many things. But what we can show is if it's really tough enforcement and high penalties, then people only look at the stricter standard. So only one standard becomes relevant, and the A standard is like irrelevant for all the types. So they all try to orient themselves on the higher standard. And the problem then is one can show that if the penalty is relatively high, we lose efficiency because of this non-controlling for these differences in types so much. So this is like sort of I found kind of interesting result. Okay, so I leave course enforcement for out there, and just conclude with the fundamental trade-off we are studying is investment efficiency through tailoring the benchmarks and the cost of enforcement of these standards, and there could be auditing as well and things like that. I mean, we put it in enforcement to be clear, but one could think about others. And the enforcement regime has the penalties and investigation intensities that are exogenous here in our case, and we move them around and see what's happening, and we see that whenever principles or rules-based approaches would be better. And it really depends on the penalties, but also on the enforcement technology and the cost of enforcement. And so this is like fine-tuning things. And I guess that the takeaway essentially is that different enforcement regimes in different countries might require different standards. So once one has IFRS, for example, that might not work similarly well in different countries with very different enforcement regimes, which is not totally new as far as I understand, but I mean, this is really where we try to look at this trade-off and how that affects optimal standard setting. So thank you very much for listening, for all your comments. We appreciate that, and we'll jump in with changes in the paper and hopefully improving the paper. So I got also the task to announce the next event. This will be next Wednesday, 28th of April, and Sham Sander will be doing the presentation. Thank you so much for having me here.